So welcome everyone to this event, which is in fact the very first event in the Quantopian book series conversations. And we are having our first book that we're going to discuss with the author of the book, Gregory Zuckerman, who kindly agreed to be here with us. So what we're going to do is that I will just start with a brief introduction. Many of you already know who he is, but he is a special writer at the Wall Street Journal and the author of many nonfiction books, including, if I'm not mistaken, the last one, which is the one about COVID-19. And there are a couple of books before that are related to finance and people in the world of finance, like The Greatest Trade Ever. And of course, the man who solved the market that we are going to discuss today. So it's our great pleasure and honor that you are with us, Gregory. And I think the plan would be for you, if you will, to talk about, half an hour or so about the book, the motivation, the main motivation behind writing the book, what was the process like researching the book, and the genesis of the book, and all the material, all the things that you think of are of great relevance to that project. And then we can spend 15 minutes or so on question and answer.
That sounds great. So, yeah, I'm just going to spend a few minutes just talking about the book I've written. It's called The Man Who Solved the Market. It is that was my sixth book. I subsequently did a book about the development of the COVID vaccine. It's called A Shot to Save the World. And just to take a step back, I'm a reporter at the Wall Street Journal. I've been here since 1996. I covered finance the whole time, different areas of finance, the credit markets. I did the Herd on the Street column for a while. I've written about private equity firms and hedge funds for many years, and now I do more investigative reporting. So I roam a little bit, I wander. So being here for a long time and being writing about finance, I would always hear about Jim Simons and Renaissance Technologies. They are the preeminent hedge fund investment firm of all time. No one has returns like they do. 66% a year on average. That's before fees, but still, it's no one comes close. So I always kind of was intrigued and wanted to write about them. I reached out to Jim years ago, and he didn't want me to write a book. Nobody there wanted to talk to me, but I decided a few years later to start doing it anyway. And partly because of those returns, and partly because they're pioneers. These are scientists there and mathematicians who were doing machine learning. They were doing artificial intelligence, AI, before it was a thing, before anybody else. We're talking the 1980s, before broader society. They were building predictive algorithms, the kind of things that determine our lives today. So they're great returns. They have impact on society in terms of being pioneers in AI and elsewhere, but they have impact in society in other ways too. Jim he passed away a few months ago, one of the most important philanthropists in the United States and probably broadly as well. The most money, I think, donated more than anybody else to autism research. He subsidized public school teachers in New York, so that they had better salaries, so they wouldn't leave to go join hedge funds like Renaissance Technologies. There's an irony there. So he's a big philanthropist, and people at his firm donated a lot of money to political campaigns and had a real impact on Donald Trump and getting him elected. So those are all the reasons why I wanted to write about Jim and his colleagues at Renaissance Technologies. And also, I just have to say there's a paradox there. A lot of my work, a lot of my books, there's some paradox. It should have been these people to have done what they did, to have changed the world. If you think about it, who should have developed the greatest investment firm in history? How about somebody who likes investing, some group of people who like to trade, who care about companies? The people at Renaissance Technologies certainly don't. They're scientists, physics, astronomy, different areas of math. Jim was a geometer. They didn't inherently have an interest in trading, and yet they're the ones who figured it out. So it doesn't really make sense. Why was it these individuals? And that is what I wrote the book about. And the book traces the life. It's not really a biography of Jim Simons. People kind of consider it as such, but It's more just sort of the people like Jim who figured it out, who developed this firm. But it is partly biography. And I'll tell you just a little bit about Jim. He grew up in outside of Boston, Massachusetts, in the United States. He always loved math. His doctor told him not to go into math. His family doctor, he said, you can't make any money in math. Ironically, eventually Jim was worth, I think at his death, about $30 billion. So the doctor was wrong. And luckily, Jim didn't follow his advice. So he liked math. He got his PhD in mathematics, geometry in particular. He's a geometer, one of the greats. He goes down as, did really well, went to Berkeley, came back and taught at Harvard and at MIT, and went to MIT undergraduate. But he did have this interest in investing, unlike the people he ended up hiring later on at Renaissance and the people there today. Jim did always he loved math. He had two passions in his life, besides his family, that kind of thing. His math, he loved math, and he loved money. He wanted to make money, wasn't embarrassed in any way. So while he was pursuing mathematics, he always kind of had this interest in trading on the side, did a little bit of investing. He eventually left academia to go work for a quasi-government institute. This is the 1970s, and they were breaking code. They were going up against the Russians, and there he learned how to build algorithms and also how to work with other really super smart, quirky people. That's who they hired. Those are the kinds of talented individuals that joined, and they worked really well together. And later on, I think it proved really important because that's what Renaissance is about, really quirky, smart individuals working together somehow, even though elsewhere in Wall Street and world of technology, it's hard to get people to work together like that. That's one of the advantages Renaissance has always had. They get people to work really well together. So Jim was at this quasi-government agency breaking code for a few years, and then he left to go back into academia. He led a math department at SUNY Stony Brook, a public school in New York State. He led that department for a while, and there he learned a different school, and that's how to hire, how to find talent, how to encourage or persuade individuals to join his firm or join his at the time it was his department, mathematics department. They were leaving Ivy School tenured positions to go this upstart department. So Jim is a good salesman. He's a great trader, a great mathematician. He's also a great salesman. So he got this talent to come over and leave. And he built this department up, and he was personally doing groundbreaking work that still is really important in the world of geometry and elsewhere too, physics. But he gave it all up in 1978 to go start an investment firm, and it was in this little mall out in New York, out in Long Island in New York, not in Wall Street. And he had this belief or this thesis that there are patterns in the markets that he can identify. And part of it is he was a scientist and he could kind of detect patterns or sense patterns, or believe that they existed and wanted to find them. So it took him a while. It started in 1978. By even the late 1980s, he still hadn't figured it out for a decade. And he went back and forth as a quantitative investor, as a traditional investor, had difficulties. There's a lot of drama in that period you can read about in the book. And even as recently as 1992, he'd figured out fixed income and commodities and currencies, but not equities. And you and I might say, okay, fine, I'm going to be wealthy anyway by trading this other stuff. But again, Jim didn't want to just be wealthy. He wanted to be super wealthy. And you can't really do that unless you conquer the world of equities because it's just a much deeper, bigger market. So it really took some other individuals that he hired or that others hired at Renaissance Technologies, people from IBM, a machine learning group, a language group at IBM, to figure out equities. And there's drama there too. It took them a while. They had false starts. They almost gave up the effort. It was a mistake that was made that someone detected, and it was a static number that wasn't updating, and it messed up their whole system, and they couldn't figure out what was going on. And finally, so this more junior person, David Magerman, gets credit for going to his boss, Bob Mercer, and saying, "Hey, boss, I think this number should be updated, right? It looks like it's static." And he said, "Oh my gosh, you're right." And the rest is history, and they kept working at it and figuring it out. And the first half of my book really is about how they made the money, how they developed the system, which today still does unbelievably well. They still do really have great returns. And they're still the preeminent hedge funds. They're not the biggest in a lot of ways, and they have these public funds that don't do so well. They're okay, but this key fund is called the Medallion Fund, and that's the one that everyone talks about, and that's the one that changed history. And it's about it's between $10 and $15 billion today. I haven't done that much reporting on it lately, so I think they maybe grew it lately, but yeah, $10 to $15 billion. So it's not the biggest, but it's a sizable hedge fund, and they kept it smaller than it could be. It could be hundreds of billions of dollars. People would throw money if they ever opened that thing up. They could raise 100 billion, 200 billion, maybe more. But they don't want it to be that big because they want the returns to be really good. And there's a lesson there in keeping size smaller than it could be. Not being greedy, they could be greedy and raise a lot of money. They're greedy in other ways in terms of they want really great returns. And they've kicked out all their investors so that the only people who really have money in this fund are the employees themselves and maybe some family members. So it's an interesting, unique fund. The first half of my book is all about how they developed the system, the stops and starts, the challenges, the obstacles, how they overcame them, kinds of people that they hire, how they work together, some lessons. There are a lot of lessons there for all kinds of people. But the second half of my book is what it did to them. All that money, it really split them in half at one point, and they were at each other's throats at one point, and over politics, really, and how the co-CEO at the time, Bob Mercer, was a big fan of Donald Trump, and half the firm didn't like that. So eventually, they figured it out and solved their internal drama. So that's sort of the last part of the book you can read about. So that's sort of an overview of the man who solved the market and Jim Simons and his fascinating life. And he became a big philanthropist later in life. And again, groundbreaking in that way, and tried to do things, all this ambitious stuff, challenges like trying to figure out how the universe began. And he didn't figure it out before he passed away. Others are still trying to get there, but I give him a lot of credit for being so ambitious in life. And he returned to math later in life as well, and loved it so much, and worked with colleagues and tried to take on challenges in mathematics and geometry. So yeah, he lived a remarkable life, and he was a fascinating guy, both a quant, but also just an interesting, quirky individual in his own right. So yeah, I'll stop here and open it up for any questions.
Excellent, excellent. Thank you very much. Now, I'm sure that there are lots of questions, and I have some, but I want to let the community ask questions. But one thing I want to ask before we open that up, did you get any reactions to the book after the book was published by the same community, Jim or others, or Mercer or Peter Brown, or any of the people that were named there, even those who were less kind of known? Did they contact you? Did they say anything? Were they upset? Were they happy? Were they,
So I saw Jim a few times after the book came out. He generally was pleased with the book. He didn't want me to write it, even as of a few months before. We met, we didn't meet. Eventually, I got him to talk to me. We spent a good 12 hours together over maybe 6 sessions, 2 hours a session, something like that. And he was helpful. He didn't tell me their secrets, but he gave me a lot of really great stuff. So he kind of came to grips with the fact that I wasn't going away and I was going to write this book. And I saw him afterwards, and he only had a few issues with the book before it was written. I gave him some highlights, and it was mostly about his wife and some personal stuff. So he seemed okay with it. And I saw him at a few events, and he was friendly. Peter Brown is the current CEO, who did not talk to me for the book. I saw at an event. I introduced myself afterwards, and he turned pale. He looked just pale, scared to talk to me. They're the most secretive firm I've ever experienced. So he didn't want to talk to me then. He didn't want people talking to me during the process. He just worried that maybe their secrets are going to sneak out. Mm. So I don't think he was thrilled with the book. Others seem to be good with it, and the reaction's been really nice from the quant community in Wall Street and finance in general.
Yeah, oh, that's great. I mean, of course, people outside the firm, I'm sure everybody, as I can tell with everybody that I've seen and I've asked that if they have read the book or they know anything about the book, even partially looked through the book, they were all very happy. And of course, looking for clues. I think
Yeah.
For many people, it was like, let me find maybe one line there that says hidden Markov models. Okay, that's the secret. Or speech recognition. That's the secret. So I'm going to go after that and see what I can dig from there on. Because as you said, I mean, there weren't really that many things published ever.
Yeah, it's funny. The retail investor, retail reader often is frustrated with the book because they'll say, well, I want that one formula to become a billionaire, Greg. Where's that one formula? You didn't put it in there. And it's not really about that. And it's funny, after I read the book, I realized it's as much a management book as it is a trading book, meaning Jim's skill was in managing talent, getting genius to work together. His genius was managing genius, someone there told me. And if you think about a lot of the lessons from the book aren't really trading lessons that you can do at home kind of thing that you want to do at home. You don't want to be going up against Renaissance anyway. It's how to find talent, get it to work together, the unique way this structured the organization is. So half of the book, I think, isn't even trading. It's more management. So yeah, I just focus on the criticisms. The criticisms have been from those kind of individual investors. And then I know Steve Cohen once told somebody he didn't find a formula. He was open to find a formula that he could use at his firm. But most everybody else seemed to have been enjoyed. I think there are a lot of lessons there, life lessons too, from this remarkable life.
Yeah, no, that's true. I agree. For those people who are looking for a clue like that, I mean, that's straightforward. Like, give me the formula.
Yeah.
How do I make money now that you have discovered it and you know how he solved? But I have to say, I mean, I myself, that's why I kept asking you about that paper, the IDA paper that they published with Bloom and others. There is always this thing that, to me, the whole IBM group in speech recognition seems to have played a key role, modulo everything else that you said. Of course, the environment you go in, the access to data and the volume of the data that you have, historical data that you talk about in the book, Strauss or somebody who was really great in
Very good. Yeah. Yeah.
getting data, keeping track of that. All of these need to come together. It isn't just one particular ingredient that makes the whole thing shine, but nevertheless, it felt always, and I don't know what you think about this, but it felt always like the IBM speech recognition group, the whole crew, and many more that you name in the book as well, besides Mercer and Brown, are people who made a key contribution, at least in the space of equities.
Yes, definitely. That's another thing. Some people have been, I don't know, whatever, disappointed. I don't know. They felt misled that they're like, well, Greg, half the book isn't even about Jim Simons. And it's true. Half the book is about people around him who made remarkable contributions, and they're interesting in their own right, in my view, anyway. So, yeah, there's that reaction as well. But I agree, Mercer and Brown, my gosh, Jim Simons wouldn't be what he was, and the Renaissance wouldn't be what it is without those two.
Yeah, that's very true. All right, great. Well, okay. Any questions? So you can just unmute and ask question. Yes, Gaurav, go ahead. You can unmute and ask your question.
Hi, Greg. Thanks for taking the time to meet with
Sure.
us tonight. I actually have your book right in front of me. I haven't quite gotten around to it yet, but it does remind me all the reviews I had read about it before purchasing it. It reminded me a bit of Black Edge, the one about SAC Capital and Steve Cohen. And it was kind of funny that you mentioned that when you had run into Peter Brown, he kind of turned pale and was a little, I guess, apprehensive because I'm not sure if you've read Black Edge. It's a great book, but the epilogue, the author actually runs into Steve Cohen at an art gallery, and he's equally elusive and apprehensive. And so I thought it was an interesting kind of similarity that Cohen and Brown share. And I bring that up because some point last year, Peter Brown actually did an interview with Goldman Sachs.
Yeah.
And it took a 40-minute long interview, and I listened to it, and I thought that, especially for RenTech, it seemed so out of character. I was kind of wondering what your initial reaction was to that and your thoughts on that are, and I guess what that kind of might represent for RenTech going forward.
So in terms of the comparison to Black Edge, I don't think it's a perfect comparison because I think if I remember from the book, the author was suggesting that a bulk of, the majority of, much of Steve Cohen's gains were illicit, were obtained through insider trading, and properly obtained. If I remember correctly, That was the impression I got anyway. And I'm not going to weigh in on whether they were or weren't, but that was, I think, the impression the author was trying to leave. And you can make some criticisms of Renaissance, but they didn't really break any laws or and such. They did have to give back some taxes, but they were aggressive with taxes, but they never broke any laws. So they did it by the books, and they're also not fast trading, flash trader kind of thing where it's all about speed and getting in front of other people. They kind of joke around internally that their systems aren't the fastest and their computers and networks and such, and that's not what they do. They're sort of a medium frequency. They're not even high frequency. Medium meaning their whole period is sometimes a few days, sometimes shorter, sometimes longer. Moments to months is what they say, or seconds to seasons. But yeah, they also don't like publicity, just like I guess Steve Cohen. I forgot the second part of your question. Apologies. Was that I know
Just yeah, just kind of what your thoughts were about how Peter Brown doing something so
oh
public.
yeah. Oh, the Goldman Sachs interview.
Yeah.
I thought the Goldman Sachs interview was great. I enjoyed it a lot. He was pretty frank. I was shocked he did it. I thought it was probably a reflection of their outside funds not doing so well. So they wanted to raise more money there. But I was also a tad frustrated only because I don't know, half the questions, half the details from the questions, maybe more, came straight out of my book. They could have just, it was like a book report. They could have just quoted from the book. But be that as may, it was kind of cool hearing some of the anecdotes from the book being chatted about between Brown,
Yeah.
who wouldn't talk to me. So that was kind of cool.
Thank you.
Sure.
All right. Any other questions?
Thanks for hosting. Yeah, just quick question. The 60% or 66% annualized return by Medallion fund, is it after leverage or is it before leverage? Another question is, why do you think Jim Simons was able to solve fixed income and currency much faster than he did with the equities market? Thank you.
Good question. I forgot. I wrote about it in my book. It's been a few years. There's a reason why fixed income and commodities currencies were easier than equities. I forget why. Maybe someone read it recently, or you can report back after you've read it. So it's in the book. And yeah, one of their secrets is the leverage. So yeah, they would sometimes not only would they use a lot of leverage at times when they had real conviction when their systems, they're quant, so they defer almost all the decisions are by the computers. You can think of them as not man plus computer, computer plus man, machine plus man. It's more machine, but a lot of man too. They do believe they're never going to be all machine. At least last time I talked to them a year or so ago, people there. Yeah, it includes leverage, and they got really inexpensive leverage, and I talk about it in the book. That's one of their secrets because their Sharpe ratio is so good, because they never lost any money, even on a monthly basis or weekly. Even there must have been, I think there was a week I write about it or two, but rarely. As a result, Wall Street is dying to lend to them, or always did. So as a result, they got really cheap leverage. So that really helped. That's one of their secrets. Yeah.
Thank you so much.
Sure.
I have a question. So Gregory, really enjoy your book from earlier this year. I think we had another book club, I think beginning of the year when we also talked about this book. So I enjoyed that as well. I think one striking thing I picked up from reading your book and also watching some of Jim's earlier interviews over the last 10 years or so, is this idea of taste, and also secondarily, what you mentioned about his ability to persuade other people to join. And I think one thing I always find really fascinating is how people sort of develop and how they evolve their taste in terms of problem selection, and also I guess a meta taste, and recognizing that these other researchers, they have good taste on what they're working on. And so I'm just curious, what's your sense based on first-hand encounters with Jim, and also like extensive research you've done, how his taste developed and evolved. And also, I'm really curious if he pointed to if there's any particular inflection, salient points in his career where he, this kind of thing like further developed.
It's a great question. He himself and others around him attribute a lot of his success in mathematics, and I guess at the firm too, to taste. How everyone defines that. I think the way they define it is he had an ability, and I think it's instinctive. I teach this. he had ability to isolate, to focus on, to identify questions that important questions that can be solved, that he may be able to solve. So I don't know how you teach that, but again, he threw himself into problems that he felt were solvable. And so as a result, you don't waste too much time. You can potentially achieve something big and great. He had great taste. It's very true. A lot of people talked about his great taste. I think that's what they meant. What to spend your time on, what not to spend your time on. I think that's what they meant by that.
I think there's also a follow-up to that, is because, as I remember, as I was reading your book, I sort of encountered all these names, a lot of mathematicians that I had maybe heard of, but like hadn't really known. So I looked them up, like Brokamp, X, Laufer, Brown, Mercer, and so on. One thing I went to Berkeley, so it's like interesting to find out I hadn't known at all that there's such a strong Berkeley connection, that there was sort of like a Renaissance West out in downtown Berkeley for a while. So I guess, tangenting on that, do you get the sense that like when he has or exhibits this kind of meta taste for people and people's taste in problems, does he sort of serendipitously just like, oh no, maybe he reads a paper and say, hey, this guy seems like he's got great taste, I would like keep in touch, maybe he already knows the guy, or like does he go about it maybe a bit more strategically, which is maybe we have a problem at RenTech, like we can't solve equities, and these are the 3 or 5 people that.
That's also a great question. No, my understanding is that he just wanted to hire smart people. And his thesis was that they would figure out a way to contribute to his firm. And what he did was, especially early on, was kind of say to people, hey, you've got no interest in hedge funds, you look down on hedge funds maybe, or investing, you couldn't care less about trading. Well, just come on over and spend a few days, give a lecture, spend the summer. And I think his thesis was, well, once they get over there, they realize that trading and investing is like problem solving, and it's one of the more intriguing and enjoyable challenges, intellectual challenges that one can have. And as such, they realize that, it's a lot of fun to be there. Also, and you're with other people. And then there's also like a peer pressure where a lot of their work is done in teams and presentations with others that work really, really well together. And you don't want to embarrass yourself. You're with other world-class mathematicians and scientists, and you're making presentations in front of them, and you want to step up, you want to show you can contribute, and there's a real peer pressure as a result. I don't know if that was conscious on his part. A lot of what they did, I think, a lot of the reason why he was so successful, I think he stumbled onto, frankly, like they internally share everything. Everybody has access to the system, and you say to yourself, wait, what? It's the most secretive hedge fund ever, the most successful one, and everybody can see every line of code. Well, why don't they just walk out the door and start their own hedge funds? And part of it is just part of it, it seems, but also part of it is these are mathematicians and scientists. They don't want to run hedge funds. They just want to make money and solve problems. And they don't know anybody at prime brokerage firms or Goldman Sachs to help them get going. And yeah, they could work on it and research it, but because they do so well at Renaissance, they've got no reason to. And it's a virtuous cycle as a result. They do really well. They reward people really well. People, therefore, have no reason to leave. Therefore, you can share internally. And I don't know if that was conscious on his part, but because he only hires mathematicians and scientists, and people that never worked on Wall Street, he doesn't have to worry about them leaving for Wall Street. So to answer your question, that those are also, again, I don't think these are conscious decisions on the part of Jim, but it worked out really well in that regard.
Makes sense. Yeah, thank you.
Sure.
Yeah, so something that comes to mind when you just said that about the mathematicians, and he did hire the very best, and it is very hard to believe that some of those people had even closest affinity to this kind of thinking in that space. I mean, yes, so like maybe none of them were that interested in making money or being in the money-making business, but the areas of some of them, like X himself or a couple of other people in number theory. And so the area is not even that close to, let's say that, for example, you're a statistician You talk about René Carmona. Okay, René Carmona being there, stochastic differential equations, statistical analysis, makes sense. He's a person who like you would go to if you wanted to have him analyze this kind of thing or look at it. But my question is more like, how did you see the landscape after in modern times, more modern times, when he wasn't the only one around? D.E. Shaw was there. There were a couple of other firms who probably also are hiring scientists, mathematicians, physicists in particular, and in fact, insist on not hiring business graduates. But again, it seems to me like he was, even in that group, the most successful, despite the competition and despite the imitation. If we call it imitation, maybe that was the plan already by others as well.
Yeah, it's unlikely. It doesn't make sense. There are a lot of smart people out there working on Wall Street, super smart people, PhDs, accomplished people.
Yeah.
I guess there is a difference in that Renaissance. Like when I do tours of Wall Street trading firms, people say, "Oh yeah, Greg, over there are PhDs, or in that corner, or in that office." Renaissance is full of PhDs, but not just PhDs. These are people that led math departments, so their talent level is still higher than most any other place I've ever seen. Again, you ran the math department at Stanford is different than getting a PhD at Stanford, which is what you'll see at the Wall Street firms. But you make a really good point. You would think other people. I mean, there are other successful quant firms. And frankly, when you talk to people internally, they're not really sure why they're so much better than everybody else. They don't really interact with these other people. They're out long geographically. They're away from everyone. They don't get together for drinks or coffee with other firms, other places. They're very secretive. So they're not 100% sure. And I keep being as a skeptical reporter, I keep waiting for them to mess up and to blow it. Everybody eventually does in my world, so it hasn't really happened yet. But I listen. They do have some advantages that other people don't. And it's funny you talk about the world class, both you and David, these world class mathematicians. I come at it. I know nothing. You guys know much more about. I mean, I was awful at math. If my late father knew I wrote a book about math, my gosh, he'd be giggling. But so I didn't realize these superstar names, and I spent a lot of time with people like Elwin Berlekamp. It was such a privilege and a pleasure and a gift to spend time with those kinds of people before they passed away. Berlekamp passed away, and these other kinds of people, René Carmona, other kinds of people. So, yeah, these are super duper superstars in the world of math, and somehow Jim got them to focus on trading, which is again, he was a persuasive guy. He's a guy who you could talk about math with him, obviously, but he also he was a smoker. He loved gin and tonic. He had a sense of humor. He was interested in others. I mean, how many people in my world, I don't know about the world of math, but in the world of Wall Street, no one cares about anybody but themselves. I mean, I'm generalizing, but Jim cared about others. He was a unique individual. He actually had genuine interest in others. So I think that's part of the reason why he was so successful.
Yeah. Yeah, should again, as we said earlier, yeah, it is a very rare combination of these things that probably stand alone may not lead to too much. Like if you are a great manager, but you really do not have the best and greatest minds around you, or you cannot convince them, then managing a bunch of people who are not that good may not lead to anybody. Or you have the best of people, but you can't manage them very well. They get into fights, they become secretive in their own silos within the institution, then again you fail. But he somehow managed to, and the others are following suit. Like, looks like it is working, whatever the secret combination is.
Yeah, it's a remarkable place and remarkable individuals, interesting, and to get them to work together is just unusual. Like you said, you get silos at most firms, even if they don't want to be siloed. It's natural. Somebody does really well one year, they want to get a bonus. They negotiate. They get their own little group, and they get trading. They silo it off. And they give them some authority and autonomy, and it's just naturally how things work on Wall Street, and it just doesn't happen at Renaissance.
Right. Yeah. And more structured ones, more formally, officially. I mean, I remember reading books about people who were like Black and Derman and others who worked at Goldman Sachs, and they were also this type of people. They were theoreticians, mathematicians, physicists in case of Derman. But they always, the only thing they recalled most was the fights they had between the traders and the other people, and then the modelers and the traders, and everybody will make fun of the others. Your models are nonsense. No, your trades are nonsense. And so probably Jim managed to bring that harmony that everybody works together.
Yeah, I remember in my book, I talked about Morgan Stanley. At one point, they had some of the greats working there, and then management didn't appreciate them, didn't pay them well. They ended up leaving, and were scattered different places, PDT, other kinds of places. So yeah, you need that combination.
Yeah, definitely so. Yeah. All right. Any other questions?
I guess following up on that thread on being genuinely caring about people, and maybe as an extension of that, being good at management, and maybe it didn't really look like management to Jim. I think so. One thing I do remember reading from the book and also elsewhere is this recurring or maybe ongoing interest, but like sort of like back and forth pull Jim into doing like VC investing on the side, right? Like I remember early on, he and his like MIT, like some Colombian classmates had like a tile factory, and they were like build tiles and then import it back into the US. And so going back to that thread, like I guess I have like a peripheral question on, like what's your impression of his interest in VC in terms of like selecting companies and entrepreneurs? And I think, on the flip side of that is, do we get the impression that the way he, managed or he built out Renaissance at various episodes, that it felt kind of like a federal system, and that it's not necessarily like super top down. It's like everyone reports to me, like a hierarchy, but rather it's like, you guys out in Berkeley, you do your thing, and then, we'll maybe talk once a day or whatever. And like, in addition to this very like open internal culture of like open code and so on, like how much do you think that played into a factor of attracting and also retaining people to do their best?
So it is a very flat organization. The Berkeley office, while important at one point, they closed that down early on, and they haven't had one in a long time. Sorry, don't be insulted by that, but Berkeley played an important early role, but that was it.
Right.
But yeah, it's a very, very flat organization, which, if you could pull it off, is ideal. You don't have the same competition. People are talking to each other, working with each other. There's not as much jealousy. Everyone tries to contribute together, no matter who they are, researchers, data collectors. It's remarkably flat. So yeah, I don't know if I call it federal system, but it's a flat organization, flat system. Yeah, it's called Renaissance Technologies for a reason. I mean, it sounds like a VC firm, right? And at one point, he was kind of going in that direction, and I think he was hedging his bets, no pun intended. He wasn't sure if it was going to work out in terms of trading, investing, and he had these interests in investing and in VC investing. And frankly, it was only after I read the book. I'm very, very focused on trading markets and hedge funds and investing and such. I'm not an expert on VC so much. And afterwards, I found out, I did an interview with Acquire, this podcast, and they were telling me how, or in the podcast, they talked about how his VC investing was, he got in early on some other big VC firm and did really well with that. So it was crazy. I didn't realize how successful. I knew he invested with them, but I didn't realize they had a really good track record. So yeah, the guy, remember, he just had this hunger to get really wealthy. So he also did some VC stuff too. And yeah, even as late as like 1989, 1990, it wasn't clear they were going to keep the trading side going. Maybe he would only do VC kind of investing.
Yeah. Yeah, I appreciate the insight. Yeah, just as I was reading it, I think it sort of reminded me of things I read about D.E. Shaw and also Two Sigma, because they are at various points in times and in different configurations also engaging in either fundamental research and or VC investing. And so I just thought that I don't know Shaw or Siegel and so on as well, but it seems like, yeah, if you have the ability to both have a good taste in your problem domain and a meta taste on who's good at it, then that seems translatable to like selecting entrepreneurs and maybe even selecting VC managers themselves as well.
It could be. I don't know the returns that places like Two Sigma and D-Shaw have had in their VC investing. It might be really good, it might not. But yeah, if you've got good taste, maybe that translates elsewhere. I'm not sure.
Right. Cool.
Thank you, guys. Nice meeting everyone, being in touch. Feel free to send me a follow-up email. And yeah, I apologize if it wasn't such a stressful day at the Wall Street Journal. I would have spent more time. But
no, thank you. Thank you very much for being here, despite all these things. I know how stressful things are.
There's a lot of news going on in this world.
Yes, Yes, yes. So
Stay
very
well,
much.
everybody, and stay in touch.
Right, right. Thank you
Enjoy
very
the book
much
if you
for
haven't
being
read it yet.
here. All right. Thanks.
Bye,
Bye.
guys.
Bye.
Thank you.